Welcome to The Real Recipe, the podcast that brings you the perfect blend of real estate trends and topics, where we serve up fresh insights and sizzling strategies. So let's get cooking. Mortgage applications.
Okay.
28-year low. Oh no, watch out.
Ryan's crying every day in the morning.
Yes. Oh. Yeah, so a lot of people are making a lot of news lately. So, well, welcome back, by the way, to another episode. That's, let's do that. That's important to The Real Recipe. Yeah, mortgage applications are 28-year low. Yeah, we're going back to like the early 2000s type of stuff. So it's no bueno. Yeah, a lot of people are talking about how the collapse in mortgage applications and the fact that the consumer has kind of retreated from the market. I don't think so. I'm not believing it.
I
Don't believe the
know.
hype, people. Don't believe the hype.
I think that, a lot of that is, whatever you're seeing out there, and people are like, oh my God, the market's so bad. And then people don't really have the pulse on what's going on in the market. And then someone asks them, they're like, oh, like, yeah, what's going on in real estate? Like, oh yeah, like it's like really slowed down. Cause I feel like I go in an office or somewhere every single day. And they're like, wow, it must be really slow for you guys. I'm like, not really.
Yeah.
It's really not slow at all. Actually, we just came out of the busiest season.
Yeah.
And I do know, obviously, that inventory is dried up in a lot of places and people are having a hard time. I think that what I'm having people tell me or what I'm seeing is that first-time home buyers are really getting kicked out of the buying pool because they're already stretched to begin with, and then starting with the
what is happening is as rates go higher, you're right. The pool is dwindling, just naturally dwindling. Just somebody who could afford something at 6% or 6.5%.
Yeah.
Right, 7.5%. Now it gets a little tighter. Payment gets a little bit bigger.
Right.
And I think that's what is probably happening more than anything else is, consumers that were getting pre-approved maybe in springtime, when rates were obviously a little bit lower. Now they're coming back to the market and they're looking at rates and going, my payments like how much higher now? And now they're going, okay, we're going to just wait and see what goes on with this market. But that has obviously caused a rather steep drop-off in mortgage applications. And what's interesting about that conversation is usually a precursor to either layoffs in the mortgage business, potentially companies going out in the mortgage business.
Seeing a lot of that lately.
Yeah, a lot of changes are going to start to happen if higher interest rates persist for a while. And I personally believe that they will. I think you're going to see rates where they are right now, and this is going to head all the way into probably the first quarter of next year. I think we'll be right around here. I don't think we're going to move much from here.
Yeah. And what's interesting too is I'm earlier in the year getting a pulse on, obviously a lot of our clients are attorneys calling and saying, oh my gosh, it gets really slow right now. I'm really starting to feel it. Obviously realtors feeling it, which means title companies and mortgage companies feeling it too. But, I know that there were some companies that had laid people off early in the year once they got into the spring. And then of course it picks back up. Now, I don't really know. I mean, maybe there are, but I don't really know like a lot of title companies that are laying people off. And I certainly feel like attorneys have gotten busier, but for the mortgage companies, the deficit that needs to be made up, whether it's, from a loan originator's perspective or in their back office, they haven't picked up enough momentum to either not, some of them have gone under, or to continue to not have to lay people off. Because I just talked to someone who worked at a mortgage company, and last week they're like, we just did a huge layoff. And I feel like I haven't even heard that term in the business at least 6 months.
Okay, so to your point there, the last 2 or 3 years, the mortgage business has been so good that I think a lot of companies
overstaffed.
No, I just think a lot of companies made a lot of money, and they're riding this out, hoping that things are going to change. But now we're coming to the end of that. Now it's like, okay, well, hold on, this isn't changing.
Right.
This probably isn't going to change for a while now. Now I need to start making some serious business decisions about the future of my company, about the future of where we're going and what's going to happen, and that involves me reducing staff.
Right.
Because what has also happened is mortgage applications have spiraled downward, costs continue to jump up. You know, it's one of the easiest ways to define that for the consumer and for people in the industry to understand like how much it costs us now as an originator. Take a look at credit reports.
Yeah.
Credit reports a few years ago for a single credit bureau would have been like $9 or $10, right? Now and for a tri-merge credit report, $30. For husband and wife, $60. Now we're talking like $100.
Right.
You know, and so it's almost doubled, you know, in the course of a year and a half, and then nothing's changed.
And now, I mean, I know it's different for title because a lot of these costs are pass-through costs, but like, is that entire cost passed on to the consumer, or okay?
Yeah.
Yeah.
For the most part.
Yeah.
Yeah. Like we can't pass through things like certain verifications if we've, you know, if they're required, you know, credit monitoring,
Right.
things like that we can't pass through.
Well, also if it hasn't closed either,
Yeah.
you kind of eat that cost.
Yeah. If the loan hasn't closed, and that's a pretty substantial cost. But, you know, mortgage applications coming down, you know, I think that at this moment in time, we just came through August, where everyone's on vacation. Now you know, school just started. Give it another week or two. Let's see what starts to happen. Because now what's funny is I'm starting to get phone calls now. Like you just saw, you know,
Yeah.
like, hey, I'm going to take out this person.
I'm back at it.
I
yeah.
haven't talked to this person in 6 months. I'm taking them out right now. Can they afford this house with mortgage rates at whatever, 7.25% or 7%? Can they do this? Okay, it's going to be really tight, but yes, they can do that. So you're starting to see those conversations start to emerge now. Now, does that translate into new business for the fall? Who knows? But with mortgage applications at a 28-year low, I mean, you see how far
we have fallen.
How far we've fallen, and you know that is, like I said, that's usually a precursor to a lot of stress in our business.
Yeah.
You know, and in particular, mortgage companies are now going to start making some really tough decisions. They're going to start laying off people. You know, real estate firms too are going to start considering, hey, like, you know, you're as an agent, you know, like you're not doing anything. Like, might as well just let you release your license and go, you know, let you go figure it out somewhere else.
Right.
We're not here to figure it out for you.
Well, I feel like normally that cleanup kind of came at the end of the year, and I'm almost seeing that happening now in the summer, at least from some brokers I've spoken to, because to keep an agent on your roster where they're not doing any business, yeah, maybe they're paying a desk fee or whatever it's called to be there every month, but it also costs the office money from a P&L perspective to have you there. So
Sure.
like you said, like they're just reaching out like, hey, if you're not going to be active, then we have to release your license, and or you have to go referral or something like that.
Yeah. I wish that there was a way for mortgage companies to have some latitude when it comes to their sales staff and originations. You know, unfortunately, they do not.
Yeah.
You know, so it makes it a little bit tougher on the mortgage companies themselves. But you know, with applications that low, you know, you're definitely going to see a lot of people see a lot of things start to happen,
Right.
You know, within the business. So 28-year low, you know, that's a tough spot to be in. But I do think that rates are going to stay here for a little while, which means that this is going to persist for a little bit here. Probably, you know, maybe the end of the first quarter of next year, second quarter of next year, you'll start to see rates pop down or come back down a little bit. And then that's going to be, I'm going to go out on a limb right now and tell you it's going to be like pandemic level stuff again.
Maybe like a feeding frenzy.
Oh my God, rates are going to go to 5.5 and people are going to freak out.
Yeah.
There is going to be riots in the street. People are going to be battle royale style at open houses looking to get their offer accepted. Like so many people want to buy. Like everybody's talking about, oh my God, the market's going to crash and this is it and we're going to recession and all this stuff. And yeah, that's cool. And that is a natural thought given the current economic climate that we're in. Totally can appreciate why somebody would think that. But this is not 2008. 2008, we wrote crappy mortgages. Strippers were getting mortgages on 5 houses when they shouldn't have. That's not this, right? This is simply, I've got 10 people. I was just talking to a realtor over the weekend, somebody you and I know pretty closely. 40 offers on a listing. 40 still to this
Yeah.
day. 40 on a listing. That means that 39 other people have to buy a house or want to buy a house.
We're acting
Where's
like
the-
that's just like the norm now. We're like
Right.
like you're saying, like 39 other people are trying to buy a house and they're all bidding. And then when 39 get denied and one gets accepted, those 39 people are just moving on to the next house. And then eventually,
it's this roaming group of
it's
40
like roaming
people.
group of people at an open house, and eventually people will be like, you know, whatever, we're gonna wait it out or drop off.
Right,
And you just
see?
have to pray that it's like you got to pray that the person in front of you in line just gives up and stops waiting, and you're like, oh great, a spot just
Right.
opened up for
it's
me.
my turn now. Thank God, finally. But so I think that even though the applications are at multi-decade lows, that doesn't mean that the buyer pool has shrunk.
No.
The buyer pool has not shrunk. The buyer pool is still the same. And as soon as you show that rates are coming down, that buyer pool is going to immediately go
Expand, yeah.
pop right back up again, and all of a sudden you're going to be back into some. Listen, maybe I'm over exaggerating it and saying pandemic level stuff, but it wouldn't shock me in the least bit if you saw rates come down 5.5%. All of a sudden you're going to be back to this same thing again, where you've got multiple offers on homes, values are increasing significantly. Now this is probably a location specific problem that we're
Sure.
having. People want to live in New Jersey. And we've talked about this, numerous times, but you're going to see this depression in applications, and then all of a sudden it's going to pop right back up again. And I think that what you're seeing today in a lot of the news feeds that we're seeing, and a lot of headlines about application. Oh my God, it's Armageddon, right? The real estate crash is here. Here we go. The recession's upon us, and this is it. Get ready. Put your hat on. Put your helmet on, and let's get save the women and children. That's not. I just don't see how that happens, or why knowing what the market looks like and where we're at, why that would happen. I just think that, hey, listen, it's the summertime, or it was the summertime, right? It's August. Everyone goes away on vacation in August. There's some seasonality to our business.
Ryan's
Always
like
has.
everyone goes away, right?
Right.
Everyone goes away, right?
People don't
We're not
travel.
here.
People,
Yeah.
summering in Europe,
Everyone
south
goes.
of France. And
Everyone
south
goes
of France
to France and London, right?
Yeah.
Yeah.
I think it was just summertime. I think it was summertime. Rates were really high. People said, "Okay, you know what? Let me
Yeah.
back out of this for a minute. I don't want to do this." And I think that's all it was. And now we're going to come back and people go back to school. Applications are going to pop back up again. Although I do think that people are going to start hearing about interest rates at 7.5% and go, maybe I'm going to hold off for a little bit.
Mm-hmm.
I think that's happening right now a little bit. But
They're like, well, it can't go any higher, so I guess I'll just.
it can.
I know. I'm saying people are just thinking like, well, it can't really get any worse, so I'll wait and see what finds out and wait to see what happens. But then people said that 2 years ago. They're like, well, I'm not paying $100,000 over asking on a property. I'm gonna wait and see what happens. And then there's like that meme right now where the guy's like, oh, really?
Is 100,000 enough? Should I do 125 or 150? What do you
Right.
think? So I who knows? Where with rates where they are right now, look, it without getting too political about it, it was a years of failed policy that put us in this position. Mm-hmm. And it's just like a pendulum. It swung too far one way with rates at ridiculously low levels that they should never have gone to. Mm-hmm. And now we have to swing it back the other way, and then it has to swing to a point where it's just so far-fetched that you don't think like, oh my God, 9% on a mortgage. Well, yeah, it may need to go there for a little bit to kind of balance out what happened,
right?
Over the past few years. So that's why I feel like it'll stay here for a little bit, and I think that part of it is by design because housing is part of the inflation number, and if you can tamp that down a little bit, it'll slow inflation down a little bit, but it does not seem to be stopping. There's just too many people wanting to buy. Unfortunately, it's as simple as that. We can talk about all this other BS about the economy and inflation and the real estate market and all this stuff, but the fact of the matter is, you today we're still hearing about 40 people looking to buy one house, and that means that only one person can, and so those 39 other people are still out there looking. Mm-hmm. And unfortunately, that's the market that we're in. In other parts of the country, that's not the case. and it is slowing down a little bit. But I think that that's also because of the location. You're in the middle of the Midwest. There's not a lot going on there. People don't necessarily want to live there. The only reason why you would move there is because either that's where you grew up or the affordability aspect of it. But there are people beginning to gravitate to those areas because of the affordability. Because out on the East and West Coast, the affordability has become a problem. It is a huge problem, and we're not addressing it. And nobody wants to talk about it, and everybody wants to just talk about how the market's going to crash. It's not going to crash. I mean, where's it going to go? 50%? I mean, that's like, what's a crash? 30%, 20%? I mean, if the house went from 600 down to 550 or 540,
right?
And you saw a 10%, drop, is that a crash?
Like, is that a crash, or is that probably what it would have gone? Yeah, is that just a correction?
It's just, one of the things that they talk about when you look at equity markets and bond markets, and you look at graphs of price appreciation over an extended period of time, one of the things that they always tell you is that, nothing ever goes up in a straight line. It will never be this straight up. There will always be points, there will be pressure. There'll be pressure in the market, and it'll have to release in some way. And I think we are at a point right now where there is some pressure in the market. It does need to release a little bit. And what does the release look like? Maybe like 5 or 10%.
Yeah.
But I mean, in our area with the amount of buyer pool that we have, I don't see it. I don't see how that's happening. Maybe I'm naive, maybe I'm wrong, but I just don't see it from a boots on the ground
perspective.
Yeah, it's just not there. But 28-year lows is a big number. I mean, when you see multi-decade lows in mortgage applications, again, that's usually a sign of something's going on. And in years past, that would have been a scary conversation to have.
Right.
I just look at it and say it was summertime. Rates are up. People are just backing out of the market for a little bit just to wait and see what happens. So let's see what happens over between, now and maybe, Thanksgiving.
Yeah.
See what really happens. I think you're going to see people come back into the market if rates can come down a little bit. But I also think that if you've got a good mortgage lender behind you, you've got some good programs out there. Like I still have rates in the 6s on some of my ARMs for first-time home buyers. So that's great. I'm still hearing about, police and fireman programs, first responder programs. Rates are in the 5s on 30-year fixed loans. So there are some things happening out there. FHA, if you do an FHA loan correctly, it may actually be worth it to do an FHA loan right now with less money down payment, even though you're paying mortgage insurance and it's not an ideal loan, but because your interest rate is lower,
if you're looking at the overall payment, then
like we talked about this on an episode a couple weeks ago, right? Where it was just like, hey, the FHA may not be so bad right now, or VA, same thing. Like you got veterans, so if you're in certain classes of borrower, you've got some options still, even though they may not be perfect, but there's still some pretty competitive.
Take what you can get right now.
But those are the people that are winning deals, because they've got good programs. They've got good money behind them.
Yeah.
Who knows? We'll see.
So
the multi-decade low in applications isn't as scary as I think it sounds. People are clickbait. That's all that is.
Yeah, we'll be here for it.
Right.
Yeah.
We're gonna get the popcorn out and watch it and see what happens. All right. Till next time.